What we mean by the accounting cycle, it's the process by which companies produce their financial statements for a specific period. It might be for a month, or it might be for a quarter, or it might be for an entire year. Here are the steps in the accounting cycle. The ones that are shown in green here are the ones that we covered in Chapter 2. Making journal entries, posting to the ledger, and preparing the unadjusted trial balance. And the ones that are in red are the ones that we covered last week in Chapter 3. Making adjusting journal entries and preparing the adjusted trial balance. The ones that are in blue are the ones that we'll cover tonight in Chapter 4. So preparing the financial statements, making closing journal entries, and preparing the post-closing trial balance. We prepare the financial statements from the adjusted trial balance that we talked about last week. And normally we try to list the accounts on the adjusted trial balance in a certain order so that it will be easier for us to prepare the financial statements. So normally the accounts that are listed closer to the top of the adjusted trial balance are the ones that are going to go on the balance sheet. The ones that are listed in the middle, and there are not very many of these are the ones that are going to go on the statement of retained earnings. And then the ones that are going to go near the bottom are the ones that will go on the income statement. So then it'll be very easy to just move these accounts over to the appropriate financial statements. One thing that's a little misleading about the way the authors do this is that for the statement of retained earnings, they only show one account here, which is dividends. Normally, you would also see retained earnings there. And the reason that they don't show retained earnings is that for this sample company, they're assuming that it's a brand new company, therefore the beginning balance in retained earnings is 0. And as I've mentioned before, if an account has a 0 balance, you don't show it at all. But it would be much more typical in a real life situation if you saw retained earnings listed there with some balance in it, which would be the beginning of period balance in the retained earnings account. Now, we've already talked about the financial statements a couple of weeks ago, so some of this is just going to be review for you, I think, but you will be preparing financial statements again in the homework for Chapter 4. We said earlier that the financial statements have to be prepared in a certain order because the information flows from one financial statement to the next financial statement. So the financial statement that we always prepare first is the income statement. And it will look something like this, where first we list the revenue accounts. And so far in chapters 1 through 4, we've only been working with one revenue account, which is service revenue. But starting with chapter 5 next week, we'll have more than one revenue account. So we'll start looking a little bit different then. And then we list the expense accounts. And then when we subtract total expenses from total revenues, that leaves us with our net income. If our total expenses are more than our total revenues, then it would be a net loss instead of having net income. Then that net income figure gets transferred over to the statement of retained earnings. There we start out with our beginning balance in retained earnings, which again in this example was 0. Then we add our net income for the period, which came from the income statement. And then we have a subtotal. Then we subtract the dividends, which came from the adjusted trial balance. And that leaves us with our ending balance in retained earnings. Then that ending balance for retained earnings gets transferred over to the balance sheet. So everything that is shown here on the balance sheet comes from the adjusted trial balance except for retained earnings. That came from the statement of retained earnings. Keep in mind that if you saw a retained earnings figure on the adjusted trial balance, make sure that you don't just copy that over here to the balance sheet, because that in fact was the beginning balance in retained earnings, and that's not what you want. Here you want the ending balance in retained earnings, and that can only come from the statement of retained earnings after you have calculated what it should be on the statement of retained earnings. Starting with this chapter, usually when we prepare a balance sheet, it's going to be what we call a classified balance sheet. That means that instead of simply listing all of the asset and liability accounts together, we're going to break them down into certain classifications. And generally speaking, the asset accounts are going to be shown in order of liquidity. And when we use the word liquidity, that refers to how quickly and easily an account can be converted to cash. And cash, you could say, is the most liquid account because it's already been converted to cash. So the asset account that we will always list first will be cash, but then the other accounts that will be listed after that will be listed in order of liquidity. The liability accounts will be broken down between those that are current, which mean they're due within 1 year, and those that are long-term, which mean they're due more than 1 year out in time. For the asset accounts, the first classification will be current assets. Current assets are those that can be converted to cash, sold, or used up during the next 12 months, or within the business's operating cycle, if the cycle is longer than a year. Then we have to define what we mean by operating cycle. Here's a diagram that shows us what we mean by the operating cycle. It's basically the period of time between which cash goes out the door to when cash comes back in the door. So first of all, the business uses some of their cash to buy goods and services. Then they sell the goods and services to their customers. Then they collect on invoices from that they issued to their customers. So at that point in time, the cash is coming back in the door. So for this operating cycle, for most businesses, it will be less than a year long. Therefore, current assets will be those that are converted to cash within a year. There are some companies, however, such as some commercial construction companies, where their operating cycle might be more than a year. So in that case, the current assets would be the length of one operating cycle. Okay, then we also on the balance sheet will show long-term assets. And there can be 3 separate categories of long-term assets. Now, in many of the examples that will be given to you in the textbook, they will only have one category of long-term assets, and that would be property, plant, and equipment. We talked last week about property, plant, and equipment. That's usually the depreciable assets. We said last week those are long-lived, tangible assets that are used in the operation of a business. We could also call those plant assets, or we could call them fixed assets. The other 2 categories that you might run into, one of them would be long-term investments. So if our company owns shares of stock or bonds in another company, we would show that investment here on our balance sheet as a long-term investment. Intangible assets would be things like copyrights or patents or franchise agreements, things that we own that are valuable, but they have no physical form to them. When we get to chapter 9 of the book, that's when we will be studying property, plant, and equipment in more detail, and we'll also be talking about intangible assets when we get to chapter 9. Okay, current liabilities are liabilities that must be paid either with cash or with goods and services within 1 year or within the entity's operating cycle if it's longer. So we've already talked quite a bit about accounts that are current liabilities. So some typical examples of those would be accounts payable, salaries payable, or unearned revenue. Long-term liabilities are liabilities that do not need to be paid within 1 year or within the operating cycle if it's longer. So now looking at the entire classified balance sheet, it would look like this. Under assets, first of all, we have a label that says current assets. And you see the current asset accounts they list there are cash, accounts receivable, office supplies, and prepaid rent. And then they have a line that says total current assets. Then they have property, plant, and equipment, and they list the various accounts there. The building and the furniture are depreciable assets. Therefore, after building, it subtracts the accumulated depreciation on the building to come up with a net book value for the building. Likewise, for the furniture, it subtracts the accumulated depreciation on the furniture to come up with a net book value on the furniture. And then it gives us a total for all of the property, plant, and equipment. And as I mentioned before, in the example here that the authors give us, they don't have any long-term investments or any intangible assets, but there will be other chapters in the book where we'll probably be running into some examples of those. And then under liabilities, you see first we have the current liabilities, and the current liability accounts they list there are accounts payable, utilities payable, salaries payable, interest payable, and unearned revenue. And then they give a total for all of the current liabilities. Then for long-term liabilities, in this particular example, they only have one account, which is notes payable. And then they show a total for all liabilities. Then for stockholders' equity, there's really nothing different here than what we've studied in the previous chapters in the book. There are a couple of different formats that can be used for the balance sheet. Here, this format for the balance sheet is called the account form. When we say that it's the account form, it means that the assets are listed on the left and the liabilities and the stockholders' equity are shown on the right side of it. The other format that's equally acceptable is called the report form. Here, the assets are listed above, and the liabilities and the stockholders' equity are shown below that. Either form is totally acceptable. It doesn't really matter which you use, but it's two different ways of preparing the balance sheet. Okay, in chapter 3, we talked about worksheets, and there's going to be one or two homework problems again in this chapter where we deal with worksheets. And the columns on the worksheet that we did not cover yet last week were the columns where we filled in the information for the income statement and the balance sheet. So those are the columns that are shown here in this example in light green and in the orangish color. So notice what we do here with the two columns for the income statement. We simply transfer over from the adjusted trial balance columns of the worksheet the accounts that will go on the income statement. And again, organizationally, those are the accounts that we put near the bottom of the adjusted trial balance. Now, we want the debit column and the credit column to be equal to one another, just like in the previous examples that we were working with last week. But keep in mind that the revenue for the income statement is shown in the credit column, and the expenses for the income statement are shown in the debit column. Therefore, if the company is profitable, if it has more revenue than it has expenses, the credit column is going to have a higher total in it than the debit column. Notice when you add up the credits for the income statement, they come to $17,500. If you add up all the debits for the income statement, they add up to $8,950. So then what we do to force the columns to be equal is we add the amount of income, net income for the period, at the bottom of the debit column for the income statement. You see where that's added here. And that adding net income there at the bottom, in fact, does make the debit column equal to the credit column. And then going to the balance sheet columns, again, we transfer over from the adjusted trial balance all of the accounts that would be accounts that go on the balance sheet. And then again, if we look at the totals at the bottom, the totals are not equal. In this case, the debit column is more than the credit column. And so what we do then to force the two columns to be equal is we add net income, but in this case, we add net income at the bottom of the credit column, and that makes the two columns equal. If you want to rationalize why it is that we're adding net income at the bottom of the credit column there, it's basically that we're updating our retained earnings account for the net income for that period, much like we would be doing on a statement of retained earnings. We're changing our retained earnings from what it was at the beginning of the period to what it is now at the end of the period by adding that income to it. And that will make the two columns of the balance sheet there equal to one another. Okay, quite a bit of this chapter deals with the closing process. Now, at the end of every accounting period, we go through a closing process. And in the closing process, what we're doing is we're zeroing out all of the revenue and expense accounts, accounts that go on the income statement. Because for the next accounting period, we want to start over from zero to measure our revenues and expenses again for that period. The balance sheet, we don't do that. We don't zero out the balance sheet and start over again. With the balance sheet, it's a cumulative record of all of our entries up until the current point in time. So the accounts that we zero out at the end of a period, we call those temporary accounts. And although they're primarily income statement accounts, the revenue expense accounts, they also include dividends. And they also include a special account that we're going to talk about called the income summary accounts. And then the balance sheet accounts, we will refer to those as permanent accounts. They don't get zeroed out. So those would be assets, liabilities, common stock, and retained earnings. We will make closing journal entries to transfer the revenues, expenses, and dividends to retained earnings. And we will, in the closing process, we will use the special account that we call income summary. And we will do that to summarize how much net income we have for the period in order to move that net income into retained earnings. Income summary is kind of an unusual account because immediately before we start going through the closing process, income summary has a zero balance. And immediately after we've gone through the closing process, income summary has a zero balance. So we just put dollars into income summary momentarily, really, to help us work through the mechanics of the closing process. There are always 4 journal entries in the closing process. And the first journal entry is the one where we close out or zero out our revenue accounts. And again, keep in mind that through Chapter 4, we only have one revenue account to work with. But in other chapters in the book later on, there will be more than one revenue account that we have to close out. So we know with a revenue account that the normal balance for it is a credit balance. So we look at the T account for service revenue down here near the bottom of the screen. It has, at the end of the period, it has a credit balance of $17,500. So if our objective is to get it down to a zero balance at the end of the accounting period, then what we're going to have to do is we're going to have to make a debit entry to that account of $17,500. So that's why in our first closing entry, we debit the service revenue account for $17,500. That will in fact bring the balance in the service revenue account to zero. And then the other side of this journal entry is automatically that special account that we call income summary. So we credit income summary for $17,500. Okay, in our second journal entry, we zero out all of the expense accounts. So just taking one example here of an expense account, it would be rent expense. And we know that the normal balance for an expense account is a debit balance. So here we see that for rent expense, the balance at the end of the period is a debit balance of $3,000. So we know that if we want to close out that account, we're going to have to make a credit entry to the rent expense account of $3,000. That will bring us down to our zero balance. And we're going to do the same thing to every other one of our expense accounts. So every one of our expense accounts is going to have a credit entry made to it to zero it out. So here you see the various expense accounts listed. Every one of them has a credit entry made to it to zero it out. And then in this case, the other side of the journal entry will be income summary, but in this case, income summary will be debited. So after you've entered all the credits for your expense accounts, then you would add up the total credits and you would debit that amount to the income summary account. Now at this point, if we look at a T account for income summary, it has a credit balance in it of $8,550. Now that happens to be the amount of net income we have for the period. So that's something that income summary always shows us at this stage, what our net income is for the period. Now in our third journal entry, we close out the income summary account. And what we do is, at this stage, we're really moving our net income into retained earnings. We're doing the same thing that we show when we prepare a statement of retained earnings. So in order to zero out the income summary account now, we know we're going to have to, as shown in the T account here, we're going to have to make a debit entry to income summary of $8,550. That will bring the balance in income summary down to zero. So in our journal entry, we debit income summary $8,550. The other side of this journal entry is automatically retained earnings, credit $8,550. So retained earnings goes up with the credit. So this in fact increases our retained earnings by the amount of net income that we had during the period. And then our fourth journal entry is to really subtract our dividends for the period from our retained earnings. So the dividends account has a normal balance that's a debit. In this example, it had a debit of $5,000. So to zero out the dividends account, we're going to have to credit it for $5,000. So here's what our journal entry will look like. In this case, we will debit retained earnings $5,000. A debit to retained earnings will reduce the amount that we have in retained earnings, and then we will credit dividends for $5,000. So this fourth journal entry, just like the third journal entry, accomplishes the same thing that we show when we prepare a statement of retained earnings. Retained earnings goes up by the amount of net income, and it goes down by the amount of dividends that are paid out. Now, if a business has a net loss for the period instead of net income, then the income summary account, before you close it out, is going to have a debit balance. Before it had a credit balance, now it has a debit balance. So we have a net loss. Therefore, when you close out income summary, in this case, the journal entry will be reversed. Retained earnings will be debited to show that retained earnings is going down, and income summary will be credited in order to close out the income summary account, in this case where we had the net loss. Okay, then the last thing we do is we prepare a post-closing trial balance. So notice we actually now have three different trial balances. We had the unadjusted trial balance, we had the adjusted trial balance, and now we have the post-closing trial balance. And this trial balance really serves the same purpose as the other trial balances, in that we want to make sure that our credits, our debits are equal to our credits, and therefore we want to make sure that we didn't make any mistakes in the process of going through our closing journal entries. If we did this correctly, when we prepare the post-closing trial balance, only the permanent accounts are going to show up there. None of the temporary accounts should show up because they should all have zero balances there. So if you saw a temporary account there, like if you saw rent expense with some dollar balance in it, you would know that you had made a mistake. Something's not right, and you would have to go back and look at your closing entries to see why you had not successfully zeroed out the rent expense account. But in this case, our debit column is equal to our credit column. We don't see any temporary accounts listed there, so it looks like we've successfully gone through the closing process in this example here. There's one ratio that's covered at the end of the chapter, and this is a ratio that is used quite a lot in business and practice. It's called the current ratio, and it measures the ability of a company to pay its current liabilities as they come due with its current assets. And so the formula for computing the current ratio is you take the total current assets divided by the total current liabilities. And they computed this, in this case for Kohl's, the department store. And in the fiscal year ending in 2015, the current ratio was 1.95. In 2016, it was 1.87. You want this ratio to be at least 1, because if it's less than 1, you don't have enough current assets that can be liquidated to pay off the current liabilities as the current liabilities come due. Now, that's not always the end of the world. Maybe you have a line of credit that you can draw on when you need more liquidity or something like that. But as a general rule, you want the current ratio to at least be more than 1. So in the case of Kohl's, it looks like it's okay, but it's getting a little bit worse from one year to the next. So it's still something that they would probably want to keep an eye on to see what's going on there in that case. Okay, before I go to the practice problems, there's 2 things I want to point out to you in my accounting lab. One is the comprehensive problem. The comprehensive problem is now available to you because it's based entirely on the first 4 chapters of the book. So once you've completed the assignments for chapter 4, you know everything you need to know to work on the comprehensive problem. The comprehensive problem is 10% of your course grade. It's due on April 6th, so you have quite a bit of time before it's due, but if you have extra time available to you, it certainly wouldn't hurt to get started on working on that. So if I click on the comprehensive problem here, and then click on the specific problem, it says it's up at the top, it says part 1 of 37. So there are 37 separate parts of it. And basically, you're going through all of the steps in the accounting cycle for this sample company. It's all the different things that we've learned in chapters 2, 3, and 4. And it's structured like a homework problem, so on each check answer part of the problem, you get 5 attempts before you move on to the next part. And you can work on a little bit of it at a time and then leave it. You don't have to do it all at one time. Most students who put enough time into it do very well on it. And so if you're concerned about your course grade, as long as you spend enough time on this, it should help to improve your course grade overall. You should certainly you'll do better than on the chapter exams on the comprehensive problem. It's not really that difficult as long as you spend enough time working on it.
It's not timed, right?
No, it's not time.
And it saves your progress as you go
Yes, it
through.
does.